In 1972, the smartest money managers on Wall Street all agreed on one thing: there were exactly 50 stocks that you could buy at any price and hold forever. They called them the Nifty 50. 2 years later, some of those so-called forever stocks had lost 80 to 90% of their value. Today I am going to tell you exactly what happened and why it matters right now. Welcome back to Daily Investor. The Nifty 50 is one of the most important cautionary tales in market history because it proves that even great companies can be terrible investments if you pay too much. These were not speculative penny stocks or fly-by-night operations. These were companies like IBM, Coca-Cola, Disney, McDonald's, and Polaroid, the absolute blue chips of their era. And yet investors who bought them at their peak in 1972 suffered devastating losses that took years, sometimes decades, to recover from. Let us break down exactly how it happened and what every investor can learn from it. To understand the Nifty 50, you need to understand the market of the late 1960s and early 1970s. After the go-go years of the 1960s, when speculative conglomerates and hot new issues dominated the market, institutional investors were burned badly. They wanted safety. They wanted predictability. They wanted companies they could buy and never think about again. And so the concept of the one decision stock was born. The idea was simple and seductive: find the best companies in America, companies with strong brands, consistent earnings growth, and dominant market positions, buy them, and never sell. It did not matter what price you paid, because these companies would grow into any valuation over time. The list included names that still dominate today. IBM, which controlled mainframe computing. Xerox, which owned the copier market. Johnson & Johnson, Procter & Gamble, Coca-Cola. But it also included companies like Polaroid, Avon Products, and Eastman Kodak, names that would eventually fade into irrelevance. By 1972, the enthusiasm for these stocks had pushed their valuations to extraordinary levels. The average Nifty 50 stock traded at a price-to-earnings ratio of over 40. Some were far higher. Polaroid traded at 90 times earnings. McDonald's at 83 times. Disney at 76 times. Coca-Cola at 46 times. The S&P 500 average at the time was about 19 times earnings. Wall Street's logic was straightforward: if a company is growing earnings at 15 to 20% per year, then a high PE ratio is justified because the earnings will catch up to the price. But as Benjamin Graham warned decades earlier, even the best company in the world can be a bad investment at the wrong price. The beginning of the end came in January 1973 when the broader market started to roll over. The Dow Jones Industrial Average peaked at 1,051 in January 1973 and then began a brutal decline that would not find its bottom until December 1974, when it hit 577. That is a 45% drop over nearly 2 years. But the Nifty 50 stocks fell even harder than the market. Their sky-high valuations meant they had the farthest to fall. When investor sentiment shifted, the premium evaporated almost overnight. The damage to individual stocks was staggering. Polaroid fell from a peak of $149 to $14, a 91% decline. Avon Products dropped from $140 to $18, an 87% loss. Xerox went from $171 to $49, a 71% decline. Even Coca-Cola fell from $149 to $44, a 70% drop, though it would eventually recover and go on to become one of the greatest investments of all time. Several factors combined to trigger the crash. First, the oil embargo of 1973 sent energy prices soaring and threw the economy into recession. Second, inflation surged to over 12% by 1974, which crushed the valuations of growth stocks because future earnings were worth less in real terms. Third, interest rates rose sharply, making bonds more attractive relative to expensive stocks. But the fundamental lesson was not about oil or inflation. It was about valuation. The Nifty 50 stocks were priced for perfection. When anything less than perfection arrived, the fall was catastrophic. Here is where the story gets really interesting. After the crash, the Nifty 50 split into two distinct groups. Some of those companies truly were great businesses, and patient investors who held on were eventually rewarded. Others never recovered. A study by Jeremy Siegel of the Wharton School tracked all 50 stocks from their 1972 peaks through 1996, a 24-year period. He found something remarkable. As a group, the Nifty 50 roughly matched the S&P 500 over that entire period, even when bought at their insane 1972 valuations. The portfolio earned an annualized return of about 12.5% versus 12.7% for the S&P 500. But that average hides enormous dispersion. Coca-Cola, bought at 46 times earnings in 1972, returned 17.7% annualized through 1996 because the business grew relentlessly. Philip Morris returned over 19%. But Polaroid returned negative 8% annualized. Avon returned negative 4%. The winners were genuine long-term compounders. The losers were companies whose competitive advantages eroded over time. The lesson is nuanced. Overpaying for a truly great business is painful in the short term but can work out over decades if the business keeps compounding. But overpaying for a merely good business, one whose moat eventually erodes, is a permanent destruction of capital. If this story sounds familiar, it should. We have seen versions of the Nifty 50 mania repeat throughout market history. In the late 1990s, it was the dot-com darlings trading at infinite P/E ratios. In the early 2020s, it was a handful of megacap technology stocks, sometimes called the Magnificent Seven, commanding valuations that made up an outsized share of the entire market. The pattern is always the same. A group of dominant companies with impressive growth records attracts more and more capital. Their stock prices rise faster than their earnings. Investors justify the premiums by arguing that these companies are different, that their moats are so wide and their growth is so durable that traditional valuation metrics do not apply. And then something changes, maybe a recession, maybe rising interest rates, maybe a new competitor, and the premium collapses. The value investor's takeaway is timeless. Quality matters, but price matters just as much. A wonderful company bought at a wonderful price is a great investment. A wonderful company bought at a terrible price is a speculation disguised as prudence. Warren Buffett himself has said, quote, "It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price." But even Buffett would add that there is a limit to what you should pay, even for the most wonderful company in the world. The Nifty 50 teaches us the single most important lesson in investing: valuation always matters. It does not matter how great the company is, how strong the brand, how wide the moat. If you pay too much, your returns will suffer, sometimes for years, sometimes forever. The best protection is the margin of safety. Buy good businesses, but only when the price gives you room to be wrong. That discipline is what separates investing from speculation. If this history lesson was valuable to you, hit subscribe. Every day on this channel, we study the real stories behind investing, the wins, the losses, and the timeless principles that separate successful investors from everyone else. Tomorrow, we have a practical how-to episode that will help you put these ideas into action. I will see you then.